You know that moment when you check your bank account after a weekend out with friends and realize you've somehow managed to spend more than you earned? Yeah, we've all been there. Now imagine you're 25. Your paycheck just arrived. And instead of building wealth, most of it is already gone. Rent, food, streaming subscriptions, the coffee habit, it all adds up. And here's the kicker. Most people in their 20s aren't just poor. They're actively sabotaging their financial future without even realizing it. Here's what most people don't realize. The decisions you make in your 20s, small as they seem, compound over decades. Literally. Compound interest isn't just a math concept. It's a time machine. And if you're doing it wrong, you're sending your future self back decades in terms of financial freedom. Hi, I'm the Calm Investor, and I spend way too much time thinking about how people screw up investing in their 20s. If you're someone who's trying to figure out where to put your money, feeling lost with the stock market, or wondering why saving $100 a month feels meaningless, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Here's the thing. Most 20s think, I'll start investing later. I have time. And look, I get it. Life in your 20s feels expensive. Rent, student loans, nights out, all of it. But here's the hard truth. Delaying even a few years can cost you hundreds of thousands of dollars over your lifetime. Let's break it down with some real math. Suppose you start investing $200 per month at age 25 and earn an average annual return of 8%, roughly the historical S&P 500 average. By age 65, that's about $465,000. Now suppose you wait until age 30. Same monthly contribution, same return. You end up with roughly $310,000. That's $155,000 lost just for waiting 5 years. This is where it gets really interesting. Time isn't just money. Time is compound interest on steroids. And yet, most people convince themselves they're too young to start investing. Now, why do we do this? Why do we keep postponing investing even though we know we should start now? It's psychology. Let's talk about a few sneaky mental traps. The present bias. We value what we can spend today far more than what we could have in the future. That $5 latte feels way better than $50 growing in your brokerage account over the next 10 years. The comparison trap. Everyone on Instagram looks like they're traveling the world, buying sneakers, and still saving. So we spend more to keep up, sabotaging our investment potential. The overwhelm factor. Investing seems complicated. Stocks, ETFs, crypto, mutual funds, and so we do nothing. But here's what most people don't realize. Simple beats complex. Let's be honest. Most people fail investing in their 20s because of 5 major mistakes. Not starting early. Like we said, waiting is literally leaving money on the table. Chasing hype. Stocks that are hot this week rarely make you rich. The average investor underperforms the market by 2 to 3% a year just by chasing trends. Ignoring fees. High-fee mutual funds and advisors eat your returns silently. You might think you're doing well, but you're losing tens of thousands over decades. No plan. Investing without a strategy is like sailing without a map. You might end up somewhere, but probably not where you want to be. Emotional decisions. Panic selling in a downturn or FOMO buying during a hype cycle can destroy your returns. Now, you might be thinking, but I don't have much money anyway, so starting small won't matter. That's exactly the trap. Even $50 a month started at age 22 can grow to over $50,000 by age 65. Small contributions matter because of time, not size. Here's what most people don't realize. Tax-advantaged accounts are your secret weapon. 401, commas IRAs. Roth IRAs. Using these early can save you hundreds of thousands in taxes over a lifetime. Dollar cost averaging works like magic. Investing consistently every month reduces risk and takes emotion out of the game. Automating contributions removes willpower friction. If you never see the money, you'll never spend it. Out of sight, into growth. Look, think of investing like planting a tree in your backyard. If you plant it at 20, by the time you're 30, it's already a small tree. By 40, it's a shade-giving oak. But if you wait until 30 to plant it, that same oak won't reach the same size until you're 50. And it'll never give you as much fruit in your 30s and 40s. That's exactly what happens with money. So, how do you fix it? Here's a step-by-step game plan. Open a tax-advantaged account immediately. Roth IRA or 401. Start with what you can afford. Automate your investments. $50, $100, $200, whatever you can. Set it and forget it. Invest in index funds, low fees, diversified, historically strong returns. Avoid lifestyle inflation. Track spending. Keep your fund money reasonable while your investment grows. Learn, but don't overcomplicate. Understand the basics. Stocks, bonds, ETFs. Don't try to time the market. Did you know the average 5-year-old spends over $1,200 a year on coffee alone? That's $48,000 lost over 40 years if not invested. Coffee versus compound interest. Just saying. Most people in their 20s have zero emergency fund, meaning one big unexpected expense can force them to sell investments at a loss. Building a $1,000 to $2,000 safety net first prevents that. Gamify it. Track your net worth and watch it grow like a video game. Social accountability. Tell a friend or family member about your investment goals. Visualize future you. Imagine yourself at 50, living financially free. This works way better than thinking about abstract returns. Look, here's the truth. Most people fail investing in their 20s not because they can't, but because they procrastinate, get distracted, or overthink. The math is simple. The psychology is predictable. And the fix? Start today, even small. Remember, time is your most powerful asset. Even if you start with $50 per month, with consistency, discipline, and a little patience, you can build wealth that feels almost magical. So, take action. Open that account. Automate those contributions. Ignore the noise. Plant your financial tree today. Your 50-year-old self will thank you. If this helped you, hit that subscribe button and give this video a thumbs up. Comment below. What's your first step going to be? I want to hear how you're going to start taking control of your investing journey today. And remember, don't wait. Start now, because every day counts.